Welcome to the deep dive. Ever wish you had a way to, quickly cut through all the jargon and financial reports to really get what the numbers mean for a company's future, not just the surface stuff? Well, today, that's exactly what we're doing. We're diving deep into one of the giants, Wells Fargo. We've got this report, Wells Fargo's strong earnings and future outlook, and our mission is simple. Pull out the key insights, give you a clear picture of their recent performance, and crucially, what might be coming next. And there's a bit of a puzzle here. How can a company have great earnings but maybe face some questions about, well, its growth?
Exactly. And what's really fascinating, I think, is going beyond just those headline numbers. We want to explore what these figures and context around them really imply for the company, yes, but also for the wider market. It's not just the what, it's the why it matters to you as someone who wants to be really informed.
Okay. Let's get into it then. Wells Fargo, that's WFC, just reported their quarterly earnings, this for the period ending June 2025. And the big news, they really smashed the earnings expectations, $1.54 per share. That easily beat the Zacks consensus estimate, which was $1.41.
Right. The Zacks consensus is that average of analyst forecasts, so it's a key benchmark.
Exactly. So beating it by $1.54 versus $1.41, that's an earnings surprise of what, over 9%, 9.22% to be precise.
Mm-hmm. Which is pretty significant.
Yeah, and comparing it year over year, last year it was $1.33 per share. So a decent jump there, too.
And importantly, this isn't some isolated event. The report mentions this pattern.
Yes, that they've actually beaten the consensus EPS estimates 4 times now.
4 times in the last 4 quarters.
Right. That consistency is interesting, isn't it?
It is. It often points towards, well, let's say strong efficiency or really tight cost management. Like they're really good at squeezing profit out of their operations, especially, when you compare it to the revenue side.
That's a perfect transition because, the revenue side, for the same quarter, June 2025, they posted $20.82 billion. Now, that did beat the Zacks consensus estimate, but only just, by about 0.5%. 0.57%.
Barely scraping past it, really.
Compared to $20.69 billion a year ago, so it's up slightly year over year. But here's the really interesting part. The report notes they've only beaten revenue estimates once in the last 4 quarters.
And that raises a key question, doesn't it, for you listening? What does that tell you? You see a company consistently nailing earnings expectations, but revenue, not so much.
Yeah, what's the dynamic there?
Well, like I touched on, strong EPS beats often suggest that operational control, that efficiency, getting more from less perhaps. Revenue beats, on the other hand, usually speak more directly to, market demand, sales growth, taking market share.
So both are good signs, but they point to different strengths.
Exactly, different strengths. And it makes you wonder, right? Is the earnings beat driven purely by cost cutting or efficiency gains? And if so, how sustainable is that without more robust top line, revenue growth? Are they hitting a ceiling on efficiency?
That's the core tension, I think. So let's zoom out a bit from just this quarter. Look at the stock. WFC shares have done really well this year, up about 18.8% since January. That's way ahead of the S&P 500, which gained, 6.6% in the same time frame?
Quite the outperformance.
So with that strong run-up and this kind of mixed picture on earnings versus revenue, what's next for the stock? That's the million-dollar question, isn't it?
It always is. Look, there's no magic formula, obviously. But one thing investors often look at is the earnings outlook. And not just the current numbers, but crucially how those analyst estimates have been changing recently.
The trend, you mean?
Precisely. There's solid research showing a strong link between how earnings estimates are revised, are analysts upgrading or downgrading, and near-term stock price movements. It captures sentiment.
Okay, so what was the trend for Wells Fargo leading into this report?
Well, according to the source, the revisions trend was actually a bit mixed, not strongly positive or negative. And that's reflected in its current Zacks rank, which is a #3 hold.
A hold? What does that signify in the Zacks system?
#3 hold basically means the system expects the stock to perform roughly in line with the overall market in the near term. It's based heavily on those earnings estimate revisions we just talked about. So it's not a sell signal, but it's not a strong buy either. It kind of echoes that tension we discussed, strong past performance, but maybe some questions about the immediate future thrust.
Right. So despite the stock's great run and the earnings beat, the analysts tracked by Zacks are sort of saying, okay, hold on a minute.
Something like that. Or perhaps the good news might already be priced in for now. We need to see what happens next.
So what are the specific expectations analysts have baked in now for the coming periods?
Okay, so for the next quarter, the consensus EPS estimate is currently $1.53. That's based on revenues of about $21.3 billion. And if you look out for the full current fiscal year, the average estimates are sitting at $5.87 for EPS on roughly $83.7 billion in revenue.
And I guess the key will be watching if those numbers change after the company's earnings call, right? When management gives their outlook.
Absolutely. That commentary is often where you get the color, the strategy hints that could shift those estimates, and potentially that Zacks rank.
Got it. Now, you mentioned context earlier. How much does the broader industry play into this? Wells Fargo is in financial investment banking, right?
Correct. And that's a really important piece of the puzzle. The source highlights that this specific industry, the Zacks Financial Investment Bank industry, is actually doing very well right now. It's ranked in the top 13% of over 250 Zacks industries.
Top 13%. That sounds pretty good. What's the real impact of being in a strong industry group like that? Is it just a rising tide lifts all boats kind of thing?
It can certainly feel like that. Think of it as a tailwind. It's easier to sail fast when the wind is behind you. And the research cited in our source backs this up pretty strongly. It shows that industries ranked in the top 50% outperform those in the bottom 50% by more than 2 to 1.
Wow, 2 to 1. That's significant. So being in a good neighborhood definitely helps.
It really does. It provides a supportive backdrop, making it easier for companies within that industry, even mature ones like Wells Fargo, to post decent results or see stock appreciation.
Can we look at another company in that same top-tier industry, maybe one that shows a slightly different profile, just for comparison?
Sure. The source mentions Interactive Brokers Group, ticker IBKR. They're in the same financial investment bank industry. They actually have earnings coming up soon, too, July 17th, for their June quarter. Now, their expected earnings are $0.45 per share. That's only a small year-over-year change, about 2.3%.
Okay, so lower earnings growth expected compared to Wells Fargo's recent beat.
Yes, but here's the interesting bit for IBKR. Their consensus EPS estimate has actually been revised upward by 2.2% over the last 30 days. So analysts are becoming more optimistic recently.
So the trend in estimate revisions is positive for them.
Exactly. And look at their revenue expectations. $1.34 billion, which would be an 8.6% increase from the year-ago quarter.
Okay, wait. So IBKR has stronger revenue growth expected and positive estimate revisions, even if the absolute EPS growth isn't as high as Wells Fargo's recent surprise.
You got it. It paints a different picture within the same strong industry, doesn't it?
It really does. What might that suggest? Different business models, maybe, or different stages?
It could be several things. IBKR, with that higher expected revenue growth and positive revisions, might be seen as being in a more aggressive growth phase, maybe taking market share, focusing on expansion. Wells Fargo, on the other hand, with its huge EPS beats but slower revenue growth and that hold rating, might be perceived as more focused on optimizing its massive existing operations, controlling costs, maximizing profit from its current base.
So both potentially benefiting from the strong industry tailwind, but executing different playbooks.
Precisely. Both valid strategies appealing to potentially different types of investors, but highlighting the diversity you find even within one top-ranked sector.
Fascinating stuff. We've really covered a lot today, dissecting Wells Fargo's numbers, that big stock run-up, but also the nuances of the earnings outlook, the hold rating, and the power of the industry context. Yeah. And using Interactive Brokers as a comparison really helped illustrate how different companies navigate even a favorable environment.
Absolutely. And I think the big takeaway connecting it all is that looking at past performance, like Wells Fargo's strong earnings, is crucial, sure. But understanding where things might be going, looking at those earnings estimate trends, the health of the industry, that gives you vital context for what might happen next with the stock. Critical thinking means looking beyond the headlines, appreciating these different layers.
Couldn't agree more. So for you, our listener, maybe a final thought to chew on. When you're evaluating a company like this one with strong past results, solid profits, but maybe a hold rating from analysts, yet operating in a really strong industry, how do you personally weigh those different factors? What does that combination tell you about where you might want to focus your own research next? Something to think about.